Today I will discuss about the stone Funch case, not merely by reading financial figures, but by understanding the meaning behind those numbers. This case is not about bankruptcy, not about management failures, and not about an immediate crisis. This case is about the paradox of growth. Stone Funch is a classic example of a highly successful company, yet that's very success created structural pressures that could become a future risk. When a company grows too quickly, its systems, structures, and international controls often fail to develop at the same pace. And that is where the core issue lies. To understand the dynamic systematically, I will divide the analysis into some major parts. Number one, phase one, stable and healthy, and two, phase two, the transformation and aggressive expansion, and three, financial pressures and structural risk analysis, and four, leadership style evaluations, and number five, the strategic reflections and future direction. Okay, let us begin in phase one with the early period. And in 1999, Stone Funch totally sales were $876.8 million, and by 2003, sales had increased to 1,218.1 million dollars. That represents approximately 39% growth over 5 years. This was strong growth, but still within healthy limits. And the revenue structures, the water product division was as a backbone of the company, and in 1999 is $724.7 million, and 2003 is $846.9 million. This division was stable and matures and generated consistent cash flow. Meanwhile, the solution division in 1999 is $152 million, and in 203 is $371.2 million, and in a peak in 2002 is $394.3 million. Solution grew rapidly, but its scale remained significantly smaller than water products. This means the business structure remained balanced and risk was controlled. And the profitability, gross profit increased from $183.8 million to $260.4 million. The margins were maintained, and net income rose from $20.5 million to $32.2 million. Earning per share increased from $2.92 to $4.60 without issuing additional shares. This is important. It means the profit growth was driven by operational performance, not by financial engineering. The balance sheets and financial structures, total assets in 1999 is $658 million, and in 2003 it's $982 million. Cash increased from $5 million to $25 million. Long-term debt rose from $37 million to $131 million. Moderate and proportional increase. Retained earning increased from $214 million to $345 million. This indicates the company grew through a combination of internal profits, healthy leverage. Conclusion of this one is Funch was stable and profitable, controlled and low risk. This was a major and disciplined organization pace. In phase 2, the transformation and growth explosion, and entering 2000, strategy shifted. The company was no longer simply growing. It was no longer ordinary organic growth. The total sales 2004 $262 million, and in 2008 $304.6 million. Growth of more than $1 billion in 4 years. This was no longer ordinary organic growth. This was aggressive expansion, and the shift in revenue structure was product growth moderately. However, solution surged dramatically. Electronics, new subsidiary ventures became the main growth engine, and in 2008, for $412 billion in revenues came from newly development products. Innovation became the primary driver of growth. The profitability is sourced in net income in 2004 is $48.5 million, and 2008 $128.8 million. EPS jumped from $5.22 to $15.90. Stock's price increased from $45 to $71. On the surface, this looked like an extraordinary success story, but let us examine more deeply. Financial pressure and structural risk, this is where the analysis become crucial. Working capital pressures, inventory nearly doubled. Account receivable surged dramatically, and yet cash declined from $23 million to $7 million. What does this mean? It means the company funds were locked into inventory and credit sales. Growth was absorbing liquidity. This is a classic sign of overexpansion. And then the leverage long-term debt in 2004 is $127 million, and 2008 is $443 million, more than tripled. The debt-to-equity ratio increased significantly, and the company became more dependent, more external financing. During high growth, this may not feel dangerous, but it grows slow, risk increases dramatically, and then the organization complexity. By 2008, 40% of assets in water products, 35% in solution, and 25% in new ventures. 7 subsidiaries reported directly to the CEO. The structure became complex, coordination became more difficult, and oversight weakened, and it's not only financial risk, but it was managerial risk, and then the dependence on innovation, EBIT from new product reached $51 million. It means the significant portion of profitability depended on continuous innovation. Innovation was no longer an added advantage. It became a necessity for survival, and that creates ongoing pressures. And then the leadership style analysis. Now we turn to leaderships. In his this one, the CAO acted as a disciplined operational managers, and in phase 2, he became a transformational leader. Characteristics included visionary mindsets and risk tolerance and innovation-driven strategy and equity ownership incentive and engineers. The 80 to 20 ownership scheme created extraordinary motivation. One engineer turned $14,000 investment into $2 million. That is a powerful incentive. However, there were weaknesses. This approach is not sufficiently balanced. This with strict financial controls, working capital disciplines, and organizational integration system. The CAO excellent at creating growth, but was less strong in consolidation and risk control. This reflects the classic tension between transformational leadership versus transactional discipline, and Stonefish leaned too heavily towards the transformational side. The strategic reflection, Stonefish in 2008 was not a failing company. It was a company at a critical turning point. It grew as an impressive, but its supporting structure was beginning to lack. The company continued expanding without consolidation. Debt pressure would increase, liquidity could then weaken, and organizational coordination could deteriorate, and innovation dependency could become a burden. However, the company controlled debt levels, strengthened cash flow management, integrated subsidiaries, and optimized the control system. The Stonefish is an example of a successful company. The company was not. This is the growth must be met control and discipline. Stonefish must be controlled, and if the company carried a heightened risk, the next strategic decision would determine whether growth become foundation long-term excellence or the source of structural vulnerability, and this is where leaderships become crucial, no longer as the drivers of expenses, but as the guardians of balance between vision and discipline. Thank you.